Hey, what's up, my friend? So in today's video, right, we'll be discussing about stop loss strategies. I know stop loss, right? It's a term that trigger a lot of bad feelings for trader, right? They bring back memories like, man, Rayner, my broker, they always hunt my stop loss, or the market always know where my stop is, right? It triggers my stop, ding, and then reverse back in my original direction, and putting me out of the trade. Okay, so I get it, right? A lot of feelings inside of you, right? That's why in today's video, right, we're going to tackle it once and for all and fix it so you know how to use a proper stop loss, right? So you don't get stopped out too early in the market and much more. Okay, so before we begin, right, just one thing to ask of you, right? If this is the first time, the 10th time, or the 100th time that you're watching my video, hit the thumbs up button and subscribe to my YouTube channel, so this way you never miss, right, another training lesson from me ever again. Sounds good? Right? Just click the button below and do it right now. 3 seconds. 1, 2, 3. Okay? Then let's begin. So the first secret that I want to share with you regarding stop loss is that there is no one size fits all. So I always, cringe whenever I hear traders say, right, my stop loss is always 20 pips, right? That's how they define their risk, a fixed 20 pip stop loss or a fixed 50 pip stop loss. But doesn't really make sense. And let me explain why. If you look at this chart over here, okay, this is the daily time frame of the dollar sing. Let me just pull out the average true range indicator. This one pretty much just measures the volatility of the market. So you can see that for dollar sing, right, on the daily time frame, the average true range for the day, right, meaning that on average, right, how many pips, right, does this market move? Right now, it moves about 42 pips a day. As you can see over here, the value here is about 42. Okay, so that is for dollar sing. So this means, right, if you were to use a stop loss of, let's say, 50 or 60 pips, right, I would say that is pretty reasonable because that is outside of the average daily range for this market, dollar sing. On the other hand, let's say you look at another market, let's say the pound yen. If you notice, the pound yen on average, right, its average range for the day is about 126 pips. Right, you can see that my cursor over there, right, there, right, 1.26. This means that pound yen on average one day it moves about 126 pips. So if you're going to use a fixed 50-60 pips stop loss on this time frame on this trade, then you can see that it's pretty much doesn't quite make sense because the range of the day, right, would probably hit your stop loss before it can even move in your direction because this market, right, typically has an average range of 126 pips per day. Compared to dollar sing, which you've seen earlier, it's about 42 pips. So this is why the first thing that I want to share with you is that when you use stop loss, right, there is no one size fits all. Number one, you have to take into consideration the volatility of the market. Okay, and that's not all, because number two, you also must take into consideration the time frame you're trading, right? If you look at this, right, pound yen daily time frame, it moves about 126 pips. But if let's say we go down to the 1 hour time frame, the range for this market, right, on each hourly candle is about 19 to 20 pips. So you can see that usually, right, the smaller the time frame that you're trading, the tighter the stop loss that you can use because the range of the market in that time frame, right, is not as crazy wild. If you just look at this, right, common sense, if you just look at this one swing from 145.50 to 144.20, that's about a 30 pip swing on this 1 hour time frame. If you look at a daily time frame, right, you just measure that one swing, right, from here, this is like 149, and here is 144. This is about a 500 pip swing. Okay, so first thing to bear in mind, right, let's just move back to the slides, right. Number one, there is no one size fits all because number one is volatility of the market. It changes from market to market. And number two, your time frame matters as well. The smaller your time frame, generally you can adopt with a smaller stop loss. So that is the first secret. There is no one size fits all. Number two, your broker doesn't hunt your stop loss. I know it's hard to believe, right? And I do agree, right? There might be a few bad eggs out there, maybe 1% or less than 1% of brokers that actually do hunt your stop loss. But the vast majority of them, right, those of them who are regulated by MAS, the FCA, they don't hunt your stop loss because from a risk to reward perspective, right, it doesn't make sense. Let's say, let's be honest, right? What is the size of the trading account you're trading? I'm guessing $300 to few $1,000. Maybe some of you 5-figure accounts, right? But not many. Most of you are probably in the hundreds to thousands of dollar figure. And if the broker wants to hunt your stop loss, what does he get? Well, he gets your trade, and what does he profit? Like what? $50, $100, $200, $500, $1,000, thereabout. Okay? And the risk, right, to the broker is that you might screen capture your charts. You can actually prove it, right? Broker A and broker B. One broker A hunts your stop loss, broker B, the data feed, right? The price didn't spike. And all they need to do is to screenshot it, upload to social media, and that's it, right? The broker risks losing their license because of trying, to hunt your stop loss. So from a risk to reward perspective, right, trying to, make $500 off of you, $1,000 off you, at the risk of losing their license, losing their reputation, and losing their credibility, to me, it doesn't make sense, right? So this is why I say that most broker, they don't hunt your stop loss, because it's not in the best incentive to do so. From a risk to reward perspective, right, traders, right, risk to reward, right, it's not even favorable for them to do it. Okay, so this is why I say most broker, they don't hunt your stop loss. However, I do agree that often you face, right, many times, you enter a trade, the market somehow, it seems to know where your stop is, right? And then it triggers your stop loss before moving back into your intended direction. Okay, so the third secret is how to avoid this stop hunting scenario. But first, right, let me explain. Why does this scenario happen in the first place? Well, it's because, right, of what you've been taught, right? If you study textbooks, if you, read materials, you know that, most textbooks and stuff like that, courses, they will tell you to put your stop loss, right, above resistance, right? They say that, put your stop loss above resistance, because if the price breaks above resistance, right, that's where your trade is invalidated and you don't want to stay in the trade any longer. So you put your stop loss above resistance, you put your stop loss below support. And this is actually one of the worst places that you can put your stop loss. Why is that, right? Let me share with you why. So this is going to be a bit technical, but just follow me step by step, right? And this will all make sense, and it's going to be like the Matrix. You will, open your eyes for the first time, like, man, Rayner, I didn't see this before. Okay, so bear with me, right? And just I'll walk you through step by step. So again, right, let me just redraw this. So okay, let's say the market is in a range. Okay. Then at this point, right, okay, say it starts to retrace a little bit, and traders will go short, right? Because hey, price is at resistance, right? Selling pressure coming in, right? Price seems to be reversing. Let me go short. So where will short traders, put their stop loss? Well, if you follow the textbook, you follow the forums, blogs, and website, they say a lot of them will tell you to put your stop loss above these highs, or maybe even above these highs over here. Okay? So as you can see that when more traders are short, right, this stop loss would accumulate. So as it accumulates more, this stop orders is essentially buy orders. Because if you are short, right, and you have a stop loss, that stop loss is actually a buy order to get you off the trade. So let's call it B, buy. Let's call it buy, just B, right? It's a buy order to get you off the trade for short traders. Okay, so that's the first thing that I want to cover, number one. So let's call it the traders who are short. At the same time, right, there will be traders who are long at this price. Around here, they are long. Maybe traders, they are those the smart money, the institution, those that can really move the market. So they are long, right? Let's say they are long somewhere at this price, or maybe they're long somewhere here, or even near the lows over here. Whatever the case is, that if you are the smart money, if you are someone with a lot of money, let's say 10 billion, 100 billion, right? You can't just exit the trade at any price level. Why is that? It's because of something called slippage. If you just randomly exit your trade, right, you will move the market, and let's say, you sell over here, the market could just collapse all the way down lower because you are the whale in the market. So what would, this trader do, this group of traders, this is smart money. So what they'll do is that they want to exit their trades, right, where there is an opposing order to help them, so-called neutralize their position. So let's say traders over here, they are long, right, and they want to sell. So where would they sell to? If they sell over here, as I've said, right, the market could possibly just reverse down lower. So what they will likely do is they will push the price up higher, okay, up to here. And when you just push the price up higher, just a few pips, right, the market will take out these highs over here. And what is above these highs over here? What lies above it? The buy stop orders from the earlier group of traders who are short, right? You're short, you put your buy stop orders just above resistance. Okay? And that buy stop orders, right, and this the traders who are long, right, they'll push the price up higher and sell their position. And who do they sell it to? They sell it to the traders who have their stops all above it. So if they push the market up higher and start selling those positions, right, it would trigger these buy stop orders in the market. So the buy stop orders comes in, the sell orders come in, and it kind of neutralize, right? So the price, right, won't collapse because there is a buying pressure to support the selling pressure. Can you see what I mean? Okay, so this is why often you see the price move up above a certain market structure, above the highs, and then reverse lower. After all the buying pressure has exhausted itself from the traders who are long, right? They push the price up higher. It triggers all the buy stop order. This group of traders exit their trades as well. Now there's no more buying pressure and the price then reverse lower. Okay, so let me explain through the charts, right, so you can see this clearly. Okay, so I know it's a bit technical, so just bear with me. Right, I'll explain it through the charts. So you can see over here again. Alright, this is one example, right? Price comes up into this area of resistance. Traders go short. Where do they put their stop loss? Above this highs or above this highs. Then the market spike up through it and reverse lower. Okay, so you can see that the market take out this highs, take out this high. So whoever have their stop loss above this highs and this highs, right, got stopped out only to see the market reverse lower. So if you're someone who is long, okay, and let's say you don't just want to sell at any level, a good place to be shorting, or rather to be selling your position, is at a level, right, where there is a opposite position or opposite pressure, opposite order that can absorb your selling pressure. So traders who are, let's say they are long over here or long over here, whatever the case is, as the market come up higher, they can look to sell over here because there will be orders, right, from the opposite side of the trade to absorb their selling pressure. So you come in, you sell over here, okay, but over here you have buy stop orders, right, to absorb this sell orders that's coming in for traders who are long to take profit. So this is why often, right, you will see market trading above the highs and then reverse lower. Okay, if you just look back, just look at your charts, right, and you'll see what I mean. Over here, market comes down, okay, trigger the lows and then reverse higher. So can you imagine, right, traders who are long at this point in time, right? Textbook say, oh, bullish candle, let's go long, stop loss below the lows or below this low over here. Market sweeps those stop loss and then reverse back up higher. Okay, so this is why, you get stop hunted, because your stop loss, right, is always at this obvious price level, right, where the smart money has incentive, right, to push the price to the level, right, exit their trade and then, have the market reverse back in your opposite direction. So this is why, this is the truth, right? This is why, and this is how the market moves. So one tip I got for you is that how do you actually avoid this scenario, this so-called stop hunting scenario? I mean, they're not really out to get you, right? It's just the way the market moves, it flows. So anyway, how do you avoid it, right? One tip that I have for you is that don't put your stop loss at this obvious level, like below this low or below this low. Give it some room to breathe, right? So let's say, for example, if you are long, let's say you are long over here for whatever reason, okay, maybe a retest of this swing low, give your stop loss, more room to breathe. So this means what you can do is use the average true range indicator. Let's say this one is, let's say the value is about 37 pips, right? What you want to do is identify the swing low, okay, and then deduct 37 pips from it. So if let's say the swing low, the value is X, right? So just take X minus 37, right? And your stop loss, right, will be at this level called Y. So just from here to here minus 37 pips, right? And let's say over here will be your stop loss, and let's call it Y. Okay, so this way, right, even if the market were to spike down to a level, right, you won't get stopped out immediately because your trade has more room to breathe compared to another trader who set the stop loss below the low and then got stopped out immediately. Okay, so this is one tip to share with you on how you can actually avoid stop hunting in this scenario. Don't set your stop loss at obvious market structure. Give it some buffer and more room to breathe. Alright, so this is number 3, right? The third thing that I want to share with you. The fourth secret, right? The larger your stop loss, the smaller your position size. So this is quite logical actually. Let's say, for example, you want to risk $100 per trade. Okay, that is maybe that's according to your risk management. That is maybe 1% or 2% of your trading account. And let's say you're trading euro dollar, and you have a 10 pip stop loss, right? In this case, right, you can actually trade, right, up to one lot, because if you know, right, one lot, right, every pip movement for one lot on euro dollar is $10 per pip. So $10 per pip, right? $10 per pip. Okay. $10 multiplied by 10, right? If the trade hit your stop loss, right, excluding any slippages or whatever, right, you will lose $100 on this trade. Okay. Now let's say you want to increase the size of your stop loss. Maybe you're trading a higher time frame or whatsoever. Your stop loss now is 100 pips. Okay. Obviously, right, in this case, you cannot be using the same one lot previously, because now that the size of your stop loss has increased, right, to 100 pips, right, you need to reduce, right, your position size. So in this case, right, your position size, you will be trading 0.1 lot, right? So right now 0.1 lot is about $1 per pip for euro dollar. So the general idea that I want to bring across to you is that the larger your stop loss, right, the smaller your position size should be. If you somehow sense that, hey, my stop loss is large, but my position size is still the same, then hey, this is a red flag, and it's something that you want to check and make sure that you didn't mess up anything with your calculations. Okay, and the fifth secret that I want to share with you is should you trade without stop loss? Because I'm sure often you've heard of traders say, oh, I don't use stop loss because after all the market always come back in my favor, right? Why use the stop loss? It gets stopped out and stuff like that. So let me just share with you a very typical classical example of what happened to traders who got involved with this market, Bitcoin. Right, so if you can recall, right, let me just get rid of the ATR for now. If you recall, right, Bitcoin in 2017, massive, right, massive, insane, huge bull run all the way up higher. So you can see that traders who trade without stop loss, right, traders who believe in HODL, hold on to dear life, traders who believe in BTFD, right, buy the beep dip, right. So we can see that market pulls back, right. Let's say pulls back to this low, they go long. Maybe they didn't get in at the lowest price, but hey, after all, market is in an uptrend, right? You don't need a stop loss. The market will always come back to your favor. So they hold on to dear life, right, and exit at the highs, right? Retest of swing high, they exit. Wow, nice, a winning trade. This time around, market pulls back again, right? They buy long somewhere, they go long somewhere here. Market retrace against them, right? But then again, they believe in the mantra: hold on to dear life. Market always rebound, and then take profit at the highs, right? Market retest back the highs, they take profit. Whoa, another winning trade. Again, third time, market retrace, right? Buy on the dip, right? If the BTFD, if to buy the dip, market will always return back to your favor. Take profit at the highs. So then take profit at the highs. Not bad. Market rallies. Okay, so we can see that now the market rallies once again over here. Buy the dip, right? So markets dip down, buy, right? After all, the market will always return. And in this instance, right, if you look to the right, the market never returns. So we can see that you have a few winning trades, right? Very high percentage of winning trade. But all you need is that one time for the market to collapse, right? Right now it collapsed until to a low of, you can see, right, 3,000 plus, right? There's no turning back, right? So yeah, you book a small profits along the way, right? A few bucks here, a few bucks there, a few bucks there. But when the market takes everything it got from you. Okay, so you can trade without the stop loss, but you have to be prepared for this scenario to happen. You will get many small wins. Let me just illustrate to you. Your equity curve, right, will look something like this. Win, a win, a win, 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 right? Small wins along the way. And then bam, dead. So that's how your equity curve will look like. So if your equity curve currently looks something like, if you're at this juncture over here, the market haven't reversed, right? This is still not too late. You can, take whatever you have made, learn your lesson and move on, right? If not, that one day will come, right, where the market just takes everything back and more. So this largely applies to, I would say, traders who trade with margin, right? There are cases where you don't necessarily need a stop loss. If you're an options trader, you buy a call option. A call option is pretty much the whatever you can lose, right, is really in the premium that you have paid. So for options trader, there is this leeway of trading without stops. Alternatively, right, if you're the trader that goes with a mental stop where you pretty much will manually exit the trade, if it hits a certain price level, then hey, you don't necessarily also need a stop loss. So these are special case scenario. The general advice I would suggest is to always go with a stop loss. So with that said, right, let's do a quick recap, right, to what you've learned today. The first thing that we've discussed is that for stop loss, there is no one size fits all. Depends on the market volatility, depends on your trading time frame. Number two, generally your broker doesn't hide your stop loss. There is just no incentive to do so. right? What happens is that you usually put your stop loss at obvious market structure, and that's why the market, is attracted to your stop loss, right? It triggers it and then, reverse back in the opposite direction. That's why we talk about, how you should actually set your stops, right? A distance away from market structure. You can use the average true range indicator to help you define how much buffer you want to use. The fourth thing we talk about is that generally, this is not generally, this is a confirm plus chop, right? The larger your stop loss is, right, the smaller your position size will be, right? This is just mathematics, okay? And the smaller your position size be, the larger the smaller your stop loss is, right? Then the larger the position size that you can put on and still keep your risk constant. And finally, right, I suggest, trading with stop, unless, you know what you're doing. Like maybe you're trading options, you employ hedging, right? Or you have a mental stop and stuff like that, all right? So with that said, I've come towards the end of today's video. I know some of you, want to learn more today. We go deep dive into stop losses. If you want to learn more about, entries, right, then go and download this price action trading guide over here, right? This is the ultimate guide to price action trading, and we will talk a lot about trading entries, techniques, market structure, how to read price action, and much more. So this guide over here, right, will definitely complement what you've just learned today, which is about stop loss. This one will be about entries, market structure, support resistance, and a whole lot more. So go down to my website, right, tradingwithrayner.com over here. Scroll down, click this orange button, right? This guide is free, and I'll send it to your inbox, right, for free. So with that said, I wish you good luck and good trading, right? Hit the thumbs up button, subscribe to my YouTube channel. Okay, do it right now. And any feedback or comment, let me know below, and I'll be glad to help. So with that said, until next time, I'll talk to you soon.